It's the most wonderful time of the year for the IRS. It's tax season, and while it may be a joyous time for the government, it's groan-inducing for most people. And we all have one thing on our minds. How do I pay less taxes? We're going to cover 5 strategies to lower your taxes over your lifetime. Hi, I'm Freeman Lindy, certified financial planner and tax specialist, and I work with folks over age 50 to help them retire successfully and stay successfully retired. I work in La Crosse, Wisconsin with clients locally and abroad, and we work on retirement mentorship to help educate as many people as we can about some of the great strategies that are out there. If you haven't followed us before, this is the first video of ours that you're following, and you like it, feel free to subscribe, give it a like, and if you have been with us for a while, glad you're still with us. You see, the strategies we cover today focus on saving taxes over your lifetime. Far too many people focus on preparing and filing last year's taxes. But by the time the year ends and we're in tax preparation mode, we've lost access to most of the available tax saving strategies. This is how most people operate, reacting to taxes of the past rather than reducing taxes of the future. Look at this Google Trends graph of the search terms related to lowering taxes. And again, if you're listening to this on the Retirement Mentorship podcast, you can switch over to the vodcast or video podcast feed to see what we're looking at. Or as always, just find us on YouTube and watch us there. But check out this graph. Over a year, interest in reducing taxes starts climbing in January as tax season approaches and peaks the week of April 15th. That's right, most people are trying to figure out how to lower their taxes on tax day. It then drops off significantly over the summer and builds a little more in November and December, with of course drops for Thanksgiving and Christmas. Thankfully, we're focused on our families and holidays, not on how to reduce taxes. The people who search at the end are proactive, trying to figure out what they can do before the year ends to reduce taxes. But most people are looking too late. Let's stop merely looking at last year's taxes and start preparing for what we will pay in taxes over our lifetimes. Before we discuss the strategies, let's clarify one thing, right? Let's clarify the difference between a tax deduction and a tax credit. The difference lies in how they reduce your tax liability, which of course is the amount of taxes you actually owe. Far too many people look at just their refunds, not how much they're actually paying in taxes. So a tax deduction lowers your taxable income, which is the income subject to taxation. By reducing your taxable income, this deduction indirectly lowers the amount of taxes you actually owe. For example, if your taxable income is $100,000 and you claim a $5,000 deduction, your taxable income is reduced to $95,000. The actual tax savings depends on your bracket, but if you're in the 22% tax bracket, this deduction will save you $1,100 in taxes, right? $5,000 times 22% is $1,100. A tax credit, on the other hand, directly reduces your tax liability on a dollar for dollar basis. For instance, if you owe $5,500 in taxes and claim a $1,000 credit, your tax bill literally drops to $4,500. Some tax credits are even refundable, meaning that they can result in a refund even if they reduce your taxes below zero. So again, here's a key difference, right? Deductions lower your income before taxes are calculated, where credits reduce the actual taxes you owe. So imagine you owe $3,000 in taxes. That's your actual tax liability. A $1,000 deduction saves you $220 if you're in a 22% tax bracket. A $1,000 credit reduces your tax bill by the full $1,000. While deductions reduce the amount of taxable income, credits directly cut your tax bill, making credits the more valuable of the two options in general. So let's look at 5 strategies to lower your taxes. This is not a comprehensive list, nor will we go into all the details, but it will help you think bigger. And at the end of the video, I'll give you some action videos you can take today to stick it to the IRS tomorrow. Strategy number 1, pay college, not the IRS. The first strategy is a tax credit, while others involve reducing taxable income and thus tax liability. Many of you have children or grandchildren who are or will be attending university. While some people have premeditated plans to help their family members' education expenses, many don't. And I've seen far too many instances of folks paying extra taxes while their students rack up extra student loans. Folks, pay for college, not the IRS. Take advantage of the American Opportunity Tax Credit. The AOTC is designed to make college more affordable by providing up to $2,500 per year per student in tax credits per eligible student. It covers tuition, fees, course materials, and other essential things for academic success. Here's how the credit works. 100% of the first $2,000 in qualified expenses are credited, plus 25% of the next $2,000. So which option would you like? Option A, pay $2,500 in extra taxes to the government to squander and let your student acquire $4,000 in extra student loans. Option B, pay only $500 in extra taxes and $2,000 to the university so that your student acquires only $2,000 in extra student loans. Or option C, pay $0 in extra taxes and $4,000 to the college, $1,500 more out of pocket, but less in taxes, so that your student acquires no extra student loans. The AOTC can only be used once per year per student, but this means only one person can claim it per student, but it can also claim it for multiple students. With up to $10,000 in tax credits per student, if you have many kids or grandkids, this can be worth tens of thousands of dollars in tax savings with some proactive planning. Other restrictions apply, so ask your tax planner about incorporating this strategy. Strategy number 2, bundle your deductions. So after the Tax Cuts and Jobs Act effectively doubled the standard deduction, most people claim it yearly rather than itemizing deductions. But for many, defaulting to the standard deduction is a mistake. With proactive planning, you can minimize your taxes by bundling your deductions. Deduction bundling is a tax strategy where you consolidate or bundle deductible expenses into a single year to maximize the benefits of itemizing deductions rather than taking the standard deduction. This approach is particularly useful when the total of itemized deductions is really close to the standard deduction anyway. So here's how deduction bundling works. Instead of spreading deductible expenses like charitable donations, property taxes, or medical expenses over multiple years, you concentrate them into one tax year so that the total of your itemized deductions surpasses that of the standard deduction. This allows you to reduce your taxable income more effectively, and of course, anytime you're reducing your taxable income, you are reducing your taxes. Suppose the standard deduction is $30,000 for a married filing jointly couple, and they have the following itemizable deductions, right? So you got state taxes, $5,000, property taxes, $2,500, mortgage interest, $4,500, and charitable donations, $12,000. Again, if you're listening on the podcast, go to the video, you can see all this in the table. So their total itemized deductions are $24,000. With $24,000 in itemizable deductions, this couple would just take the higher standard deduction of $30,000 every year, right? They're not quite there. However, they could bundle their deductions into one year. Property tax bills are often issued in December and payable the following year. However, if they already paid last year's property taxes in January of this year, they could pay next year's taxes in December of this year as well, effectively sliding 2 years of property taxes into 1 year. If they give $1,000 monthly into charity and they have the funds, they could pre-give all $12,000 of next year's giving in December, right? Thus, over 2 years, their deductions, squeeze them together, and they would look like this, right? So without, with no planning, with planning this year and with planning next year. So again, just look at the table in the video and switch over from the podcast to the vodcast. It'll be easier, right? But state taxes, that's not going to change, $5,000 all a year. But originally, where they would have paid $2,500 in property taxes, they're now going to pay $5,000 this year and $0 next year. Again, they're going to pay $4,500 this year in mortgage interest either way, but that will go down next year as they start paying down their mortgage. They'll pay less in interest. And then again, normally they would have paid $12,000 in charitable donations, but now they're going to pay $24,000 this year and donate nothing next year. So now their total itemized deductions would have been $24,000, but with doing all this, they can make it $38,500 this year, and then it'll drop way down to like $9,000 in the next year. But what they can do is they can take the itemized deduction this year of $38,000 and then drop back down to the standard deduction next year. Quick note too, because paying mortgage down reduces mortgage interest and the standard deduction increases yearly, it generally makes more sense to pull future expenses into the current year rather than push this year's expenses into next year. By bundling deductions, this couple would itemize deductions this year and claim the standard deduction next year. In this example, if they can claim an extra $8,500 in deductions this year and the same deduction next year, they would be better off, right? At the 22% income tax bracket, that's almost $2,000 in savings. So why is this a lifetime tax saving strategy? Well, you can bundle deductions every other year, right? And so if you add that up, you are saving tens of thousands of dollars in taxes by doing your deduction bundling. Your tax planner can help you set up this strategy. Strategy number 3, compound your triple tax advantage. Do you have a health savings account? Have you invested it? If not, do it and compound your triple tax advantage. A health savings account is a tax-advantaged savings account designed to help you pay for qualified medical expenses. To open one, you must be enrolled in a high-deductible health plan, which means you pay lower monthly premiums, but cover more out-of-pocket costs before insurance kicks in. So here's how it works, right? You contribute pre-tax dollars to your HSA, which reduces your taxable income, thus reducing your taxes for this year. The account then grows tax-free, and these funds can be used tax-free in the future for eligible health expenses, like doctor visits, prescriptions, or even dental and vision care. Most people know how these things work, but they stop at a health savings account. They put their triple tax-free funds into a savings account earning zero interest just to get the deduction. Many also only contribute as much as they will spend on medical expenses that year. So if they're going to spend $1,000, they only put $1,000 in. But that's a mistake. Don't treat your HSA like a transactional checking account. Instead, get a health savings brokerage account and invest your HSA. Max it out every year and invest what you don't plan on spending that year into investments. And maybe you're going to invest all of it. That's fine too. But by doing this, you are compounding the triple tax-free effect and giving your future self options for withdrawals to minimize future taxes. I generally recommend that my clients save in this order, right? Number 1, contribute up to the match in your employer's 401k. Can't miss out on that free money. But then number 2 is to max out your HSA, your health savings brokerage account. And then number 3, explore Roth IRAs and additional 401k, all that. So did you catch that, right? Maxing out and investing in HSA is better than a Roth, but you must invest it or the strategy doesn't work. There are other requirements and stipulations regarding HSAs, and there's a lot to know about investing, so make sure you ask your tax planner if this strategy is right for you. Strategy number 4, give to charities, not the IRS. Tax savings becomes even easier in retirement with qualified charitable distributions, or QCDs. A QCD allows individuals aged 70 and a half or older to donate directly from their traditional IRAs to a qualified charity. The key benefit, this donation is tax-free. Right? Normally when you withdraw funds from an IRA, that amount is added to your taxable income. But with a QCD, that money goes straight to charity, bypassing your taxable income altogether. Thus, you don't pay any taxes on it. And because charities aren't taxed either, the money is never taxed. Even better, QCDs can count towards your required minimum distributions, or RMDs, starting at age 73 or 75, depending on when you were born. This means you can fulfill your RMD obligations while supporting causes you care about without increasing your tax bill. The annual limit for QCDs is $100,000 per person, so it's a great tool for substantial giving. Using a QCD reduces your taxable income, potentially lowering your overall tax burden and making a meaningful impact on your favorite charities. It's a win-win for your finances and for philanthropy. Remember that this is available when you hit age 70 and a half, not necessarily your RMD age. I see many people over this age, but not yet quite their RMD age, giving to a charity from their bank account and paying taxes on their IRA withdrawals. Flip that around and you can give directly out of your IRA and reduce your taxes. You can set up pre-planned gifts, or if your IRA is at the right custodian, you can get a checkbook for your IRA and write checks directly to charities right out of the account. Just make sure you have enough cash in the account to cover any gifts that you're writing out of there. Ask your tax planner if you should switch to QCDs or even postpone some charitable giving until you can fully utilize this strategy. Strategy number 5, proactively pay less taxes. We have 2 choices regarding our retirement accounts and taxes. We can wait around and reactively pay extra taxes, or we can proactively pay taxes now to reduce our lifetime taxes. The most common method for this is the Roth conversion. In short, we move money from our pre-tax IRA to our post-tax Roth IRA. This allows us to pay taxes now and let that money grow tax-free forever. This is a big topic and we've covered in other places which we'll link to in the description. Most importantly, ask your tax planner if a Roth conversion strategy is right for you. If you have a good one, they will have already told you the answer. So lastly, let's cover tax preparation versus tax planning. You may have noticed that after each strategy, I recommended you ask your tax planner for help, not your tax preparer or tax professional, because a tax professional is anyone who works on taxes for pay, and a tax preparer is someone who prepares and files taxes. Neither of those titles indicate that they have the competency or capacity to help you with tax strategies. I recommend that you work with a tax planner. These folks have the knowledge and skills to help you plan and execute these and many other tax saving strategies. Tax preparation looks at last year's taxes, hunting for deductions and credits, and shows you what you owed for last year. Tax planning looks ahead to the coming years and decades and hunts for strategies that can reduce what you owe over your lifetime. We'll pay the IRS every dime we owe them, but let's not leave them a tip. So get tax planning. My firm, Lacrosse Financial Planning, has several tax planners, right? We are a fee-only fiduciary certified financial planners, meaning that we have the expertise to advise and guide you on all your finances without selling any products. Further, a number of us are also enrolled agents, which is the federal license to file taxes and represent taxpayers before the IRS. Here's what this means. We can prepare and file your taxes for last year. We can evaluate your situation and recommend tax saving strategies for next year and beyond. We offer basic tax preparation to people looking for help last year and a premium tax planning service for anyone looking to be proactive. Even if you already have a financial advisor, you may still want someone to get tax planning. If your CPA is always telling you to ask your financial advisor about certain questions, and your financial advisor keeps saying, I can't give tax advice, go ask your CPA, then it's time to get a tax planner. We can connect the two in a world of siloed professionals. So take action, right? Go to lacrosse.tax and explore our tax prep and tax planning options. We work with people locally and remotely nationwide and specialize in working with folks over age 50. Our tax planning will look at your broader situation, show you how much you are likely to pay in taxes over your lifetime, and provide strategies to reduce those taxes. You'll get a planning meeting with an interactive presentation and a 1 to 2 page plan with results and recommendations. So again, go to lacrosse.tax or follow the link in the description to schedule your services. I hope these 5 strategies to lower your taxes over your lifetime have sparked some ideas, but ideas are worthless without action, right? If knowledge were enough, we'd all be billionaires with 6-pack abs. So be proactive and get the guidance you need to help you keep more of what's yours. If this has been helpful for you, give us a like and a subscribe if you want more content just like this. Also be sure to check out retirementorship.com, and there you can check out our books and our magazines and all the other content that we put out totally for free, helping you to retire successfully and stay successfully retired. I'm Freeman Lindy. We'll see you next week. Cheers. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, or you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers.